Hey, my name is Hugh Kimura and I'm the founder of Trading Heroes. In this video, I'll share with you potential opportunities that can arise when the stock market crashes. I'll show you what happened in previous crashes and how we can use that information to profit from future crashes. Okay, first let's talk about the advantages of Forex versus the US stock market. So on this graph, I have a graph of the S&P 500 in blue, the blue line chart, and the black and white candlestick chart is the currency pair that I'm currently looking at. So as you can see, this is the weekly chart, and the stock market doesn't have a whole lot of correlation with this pair. Now, as I cycle through the currency pairs, you'll see that there's some correlation with some, with others not so much, and others are inversely correlated. So this shows that Forex can be a good diversification away from the stock market because, as history has shown us, the stock market tends to go up and then it has these sharp corrections which catch a lot of people off guard. So Forex can provide some trading opportunities when the stock market drops and there's a lot of volatility. Another thing to note here is that when you look at the graph for the stock market, there's a strong upward bias. There's a bullish bias. And when you're buying and selling, it's a lot easier to go long than it is to go short. If you have to short a stock, as you probably know, you have to borrow it from a broker, and not all brokers are going to have certain stocks available to short. Whereas with Forex, it's equally easy to go long and short, so you don't have to worry about rules that only apply to a short or to a long. All right, now let's take a look at some opportunities in the stock market itself. So when the stock market crashes, it brings all the stocks with it, the good stocks, the bad stocks, the average stocks. So a stock market crash is a great opportunity to buy high quality stocks at a low price. Now, naturally, people ask me, what stock should I buy? And I don't make stock recommendations because I personally believe that you should buy stocks that you know a lot about. At least you know the company really well or the industry really well, and you know who the leaders are in that industry. And when you know an industry inside out, then that gives you a lot more staying power and a lot more confidence that when you buy that stock, it'll go up as you anticipate. However, if you don't know anything about the industry and you're just buying the next hottest stock tip, then that's when you usually bail too early or you hang on to a loss too long. So you should invest in stocks that you know a lot about, but that's not all. In a second, I'll give you a tip on how the hedge funds buy their stocks and how you can do the same. But first, let's take a look at an example. Let's take a look at Microsoft. So during the dot-com bust of 99, Microsoft went all the way down here to the low 20s, mid-low 20s. Now, that could have been an opportunity to buy if you thought Microsoft was a good company. However, if you didn't know anything about Microsoft and you just bought it because everybody else said it was cheap, then when price started to go sideways like this, you probably would have bailed out, probably at a loss also. And then when you scroll forward, you have the 2008 financial crisis and price went even lower. And if you weren't out by then, you weren't scared, then you probably would have been shaken out at that point if you didn't know anything about Microsoft and you didn't think that it was a good long-term company. However, as we know, fear rules people, and when people give into fear and they don't have any knowledge about the situation, then that's when they lose money. And when we scroll forward, Microsoft made a comeback and they went to all-time highs of about 190 up here. So this is a perfect example of knowing a stock, knowing the industry, and being able to weather the downturns. Now, obviously, you wouldn't have caught this entire move. However, you could have got a big chunk of the middle and still made a lot of money. So now the question is, how do you know when a stock has hit rock bottom? Well, you don't know. Nobody knows. And if somebody tells you that they do know, they're lying. So what you can do, however, is spread out your risk when you're purchasing these stocks. So what the hedge funds do is they buy these stocks in tranches, in little increments that allow them to minimize their risk, but at the same time, take advantage of the upside opportunity. For example, during the 99 crash of Microsoft, maybe you bought some here, and then Microsoft went sideways and it looked like it was gonna go down, but then maybe you caught this dip here, and this was another opportunity to buy. And then maybe you took a small position when the financial crisis hit, and maybe you purchased around here. And then when price started to go back up, you just sat on those three positions. And then you wrote it up to a price that you felt was good and you got out at that point. But in this example, you took three small positions, and if one of those positions didn't work out, then you could have bailed out, reassessed, and possibly re-entered. But if you took your full position on the first trade, you wouldn't be able to weather the downturns and therefore could not benefit from the upside. So those are a few quick tips on how to profit from a stock market crash. This can be used during any stock market downturn because the same principles always apply. I hope your trading is going well, manage your risk, and thanks for watching.